Join this stream.
All right, so what we'll be looking at today is called deductibility of interest expense on loan from foreign related entities. My name is Adekunle Cole. I'm privileged to be the managing partner of KCP. For those who are joining this public episode for the very first time, this is not the first time we are having a similar topical issue being discussed. For you to have an insight or a brief over what we have done before now, you can please check our various social media handles, particularly that of the YouTube. We have most of those previous episodes uploaded there. So so that we can finish early, we have a lot to discuss today. We'll just go straight to the main deal. So we start. So we consider the need to actually bridging the knowledge gap among various professionals. That's why we bring this to everybody's awareness. We can actually rub minds and see within the tax regime, this current vis-a-vis the previous one, what are the major things that have actually changed with respect to interest expense. So in the course of this, we look at what capital is, definition of think capitalization vis-a-vis capital flight. We have a brief around base erosion profit shifting because it's very much related to what we are discussing today. Then interest deductibility, proud the introduction of the Finance Act of 2019. What happened, how is interest with respect to loan obtained from related parties that are foreign, how is it treated before now, and effective 2019 by reason of the relevant provisions of the Finance Act, what has really changed. So we want to rub minds on this such that when either as consultants, accountants to your various employers or tax administrators, because we have each of these personalities or discipline well represented here today. We know how best to address issues objectively when one presents itself. Then we look at what happens after Finance Act of 2019 too. Then we take one or two practical scenarios to actually drive home our point. So we are good. You will agree with me that no business can actually kickstart their process without equity interest being provided or contributed by the promoters of that business, right? Many a time, the owners of the business may not be able to provide sufficiently every resources required to fund the business process. So you could have instances where the owners are disposed to providing all the resources being required, but on many occasions we have instances where part of these resources may be provided while the balance may then be sourced from other third parties. So we start this way by saying capital is the fund or resources required to start or finance the business process. Usually, while some business are self-funded, others requires assistance. So, and that assistance and the underlying documentations is what actually attract our concern today. So we are looking at three different scenarios where or how this external finance can be provided. First scenario is where you are sourcing this loan or debt instrument internally within the country. The second scenario is where these resources are actually sourced from across the border from any other foreign entity, but has no prior correlation or relationship with the entity in Nigeria. Then the third scenario is where these resources are actually sourced from entities that are somehow or technically related to the entities in Nigeria. Let's put perspective to this. We have company ABC in Nigeria who has just commenced operation or has been in operation for quite a number of time, right? And long-term liability is being sourced in the form of debt. So this entity can actually approach any entity disposed to providing that facility in Nigeria without having or being related to each other in any way. In this context, it means that that loan arrangement is done at arm's length. So the cost of capital, the cost of equity or debt, sorry, the cost of debt, I meant to say in this respect, what is the tax implication? That is the first scenario we'll be looking at as we go on today. The second scenario is where ABC Limited in Nigeria decides to approach any entity outside the regions of Nigeria, say XY. I lost you at a point. Please confirm if you can hear me. Confirm, please, if you can hear me. Indicate I or yes on the chat box if you can hear me. Okay, good. We are good to go. So let me reconnect or project my screen back. I would also like a scenario where you actually confirm your understanding of the previous case I put forward. Do you understand what I was trying to explain before now? A situation whereby an organization in Nigeria requires funding because they could not provide all the resources required for their business. They have three opportunities or will be ways they can get those funding. They can get from any entity in Nigeria to whom they are not related. Two, they can get from any company outside Nigeria to whom they are not related. They can also get from entities outside Nigeria, but to whom they are related. So the essence of our discussion today is tax-wise, is there any differences in the taxability or deductibility of would have been interest cost in these three regard. So let's go on from there. I believe you understand the foundation I've been able to lay. So this support when offered with no intention for repayment at terms grant. So there are instances where you can actually get this funding without any expectation of repayments, right? Where you have such, it will then be wrong for us to call or term that funding loan because there is no expectation of any refund. But where it is expected that that advance that you have collected or obtained is expected to be refunded, but also with an interest, then that actually could qualify as a liability. Depending on the period of the repayment, it can be termed current or non-current. Current within the context that you expected to repay within a year. Non-current within the context that the period of repayment is over a year. So, and I've been able to here lay perspective to what category we can give to whether it is a current or non-current. In terms of current, examples in this regard, of course, I'm sure we all are on the same page on this regard, may be payables, accruals, arrears, but where it is non-current, then it could be a debenture, it could be loan, and it could be any of preferred debts nomenclature that must have been given to it, right? So we've been able to establish that there is a possibility that a company which has just commenced operation or has been in operation can be self-funded. When you are self-funded, it means no third-party finance or financial instrument is being provided to aid the company operations. But instances where you need one form of assistance or the other, and the period of repayment is within a year or beyond a year, then it can then be termed that such company already had or may have what we call debt instruments within its capital structure, right? When I say capital structure, I'm looking at how is the asset of a company funded? Is it entirely funded by the equity, or is it funded with a combination of the equity and the debt instrument? It is essential that in a normal structured company, which is not expected to have been highly geared, the proportion of equity contribution, that is contribution by the owners of the company, is expected to be greater than that of the debt instrument to third parties. Where it is otherwise, that is the debts or the liabilities is much more than the equity contributed as a way to financing the assets of the company, such company could then be regarded as being thinly capitalized. So think capitalization is just trying to measure the proportion of equity contributed and the equity contribution, I mean to say, and the debt contributions to financing a company by the would-be parties, right? Prior to 2019, Nigeria consciously don't have any policy around thin capitalization. So any business, whether in Nigeria or any of the multinational or any member of a group of companies, could actually structure its loan instrument in any way to giving it the best advantage. But with effect from 2019, there is a deliberate step taken by the government in Nigeria to addressing this concern. So that being said, having laid the requisite foundation, it is also clear to stress it here that those who are providing this funding, whether internally as shareholders or externally as debt financial instrument providers, expect returns in one form or the other. It is suffice to say that when this funding is provided by the equity holder, they will expect that their returns will be in the form of dividend, right? But where it is provided by other parties other than the equity holders, they will expect returns in the form of interest. Gradually, we are trying to build in this up, and I will just expect that you will have, as much as possible, avoid distractions, note your questions, and During the open section, you can then ask the question. Right? That being said, the higher the interest to be recognized as allowable expenses on loan, the more advantage every company will have. My point in essence is this. When you have all your finances being provided through equity instruments, typically we say there is no tax advantage, right? Because any compensation you are giving to the equity holders as dividend is non-tax deductible. So technically, one could then say that it is more advantageous, even if you can, or you are in a position to be able to provide the requisite fund needed by your business. It might give you one or two advantage if you just provide a portion of it and while you source the other through a debt arrangement, because the additional expenses that could have been incurred as interest expenses is then taken as a tax deductible within the context of our tax laws in Nigeria, right? So every company is expected to overhaul its capital structure and see whether those structures are made in a way that will give it the best or maximum tax advantage. So let's take a typical look at entities that have actually identified these loopholes in our tax law in Nigeria, and most of which have been utilizing this, haven't put this into perspective in their capital structure. So I'll take a case of a multinational with the aim of achieving huge overall group profits, might carry out an aggressive tax planning through setting up subsidiaries with geared capital structure. So when I say geared capital structure, let me get the public opinion about, the participants' opinion about this. When you say a company is highly geared, I think I mentioned it in the course of my presentation. What does it mean to you? Let's just use the chat box. When you say a company is highly geared, what do you think that means? When you say a company is highly geared, what do you think it means? Let me get your view about this. If you have an idea, please just engage, use the chat box, okay? Sonny, it doesn't mean that the company has a lot of cash, no. Yeah, Sean got it right, saying they have a high debt financing, much more than their equity. Yeah, that's correct. Thank you very much. Okay, Tibe also confirmed that the proportion of debt is more than that of the equity. Absolutely correct. Absolutely correct. So we are in good platform. So it means that most of the multinational you see around are intentional about what will be the structure of their capital, right? If they want to so take advantage of this loophole in our tax law prior to 2019, they will structure most of those subsidiaries they have in the diaspora, particularly in Nigeria, in such a way that they appear to be highly geared, right? Because of that, why are they doing that? They are doing it because as much as possible, they want to be able to flight their capital in the form of interest to regions within their reach that will give them the most tax advantage. So the interest payment on debts will be paid to the parent company or any member of the group operating from a low tax region with more than 10% or less as final tax liability on the portion that will have been taxable profit. So what are we saying? We have an instance where a company, as opposed to being entirely exposed to tax in Nigeria to the tune of, say, 32% per annum, CROW 2019. When I say 32%, I mean 30% for CIT and the 2% for the education tax. So they could have structured their capital structure in such a way that the larger portion of these profits will have been paid out of the company, out of the country or the region through or as interest, right? And you will agree with me that when you are paying any form of interest in that regard, the maximum tax advantage, implication on it, provided whoever you are paying the tax to is not further or is not having any further tax exposure or obligation in Nigeria. The maximum exposure will not be more than 10% that presumably will have been deducted as withholding tax, right? So because of this, companies of that nature structured their capital, make their capital structure appear in a way that will give them less exposure to a cap of 10% as withholding tax. So let's put numbers to this. Assuming you have company A that has made a total profit of say 100 million, and you have company B of the same size and status, given the same volume of reach and revenue end, so that company too has a total profit of 100 million. If A has not taken any loan facility, that total profit will have been accessible to tax at the rate of 32% cumulatively. Let's just put it as a straitjacket amount. So 30% being the CIT, given that accessible profit and the total profit is the same, 2% of that will also have been paid as education tax. So 32% of 100 million will have meant that 32 million would have been payable as tax by company A. Now let's now look at company B, who also have the same form of client base and make the same revenue, and by extension having total profit or accessible profit of 100 million. But before considering the interest that could have been paid on loan obtained from a related entity, let's assume that the loan that has been obtained and the interest on that loan is about 25 million. So technically for company B who has taken up that loan facility, effectively their taxable profit after deduction of the loan interest will no longer be 100 million, but 75 million. Right? So if that is the case, who can confirm in figure what will be the tax payable by company B? If you hear me, please confirm in figures. Given that scenario, we have been able to establish that the tax exposure for company A will have been 32 million. Then for company B, if you have total profit before the deduction of interest expense of about 25 million, what would be the tax exposure after you have considered the interest expense? Anybody? All right, it may just confirm that it's 24 million, absolutely correct. So with this scenario, it's very clear that on many occasions, taking advantage of that interest expense is more advantageous. But as accountants, as tax administrators, as consultants, it is very key and very important for us to pay attention to what is the source of that interest, as opposed to just recognizing it as a tax deductible, because depending on the source and the surrounding circumstance, it may not be entirely deductible. That's our point in the course of this presentation. So this slide speaks to the illustration I had earlier given, that which actually affirms that it's more advantageous for you to have taken, or for any company to have taken, that loan instrument. All right. Having cleared that, the second thing we need to also understand is what exposure, what correlation do you have between the topical issue of today, interest and its deduction, vis-a-vis BEPS. But before I go on, what do you think BEPS mean? We have an idea. What is BEPS? Who has an idea? Anyone? Anyone who can tell us what you think BEPS means? What is the full meaning of BEPS? I'm sure people are not checking the Google now. And base erosion, not base earning per share, no, not basic earning per share, but rather it is base erosion profit shifting. All right, please, this is a very topical issue in taxation of today. And what does that mean? It means that there are models that companies across the world, particularly the multinational, uses in such a way that we give them tax advantage. And how is this done? They intentionally structure their tax planning in a way whereby they can actually shift profits from regions or country that will have been taxed more, or to whom or where they could have paid more tax, to regions where they could have paid less or no tax, right? So this BEPS principle is actually principle taken or sponsored by OECD as a way to curbing these excesses, right? And if you will agree with me, the earlier scenario that I painted around multinational structuring an highly geared subsidiary in a particular region, say Nigeria, such that more of their profit can be carted away through huge interest, is actually further supporting this submission that BEPS is not in favor of any taxing authority across the world. So tax authorities over the world are concerned about excessive interest payments employed by multinationals for purpose of eroding profit tax base, right? So among the various action points that have been provided as a way to curbing various ways by which they've been cutting away these profits illegitimately, right? One of those means is what we call the interest deduction, right? And that is their fourth action point on BEPS. So OECD proposed the BEPS action point to restricting the interest expense claimable as deductions from related parties to a certain percentage of earning before interest, tax, depreciation, and amortization, which we call the EBITDA. That is, what we are trying to say here is that because of entities, multinational in particular, that have been structuring their operation in such a way that they can have that maximum tax advantage, BEPS principle is now has now provided that where there are related party transactions resulting into payment of interest to any benefiting parties within that group, right? The portion that will be claimable as a deductible expenses is only a certain percentage of their earnings before interest, tax, depreciation, and amortization, right? But in each regions or countries across the world, every country is at liberty to set what percentage of this EBITDA that will be granted as a deductible interest expense. In Nigeria, only 30% of the EBITDA has been legitimately stated in our tax law as being deductible. But here we want to look at, before we even talk about the recent provisions as proposed through the BEPS principle, what is the position of our tax law before now? What is the impact of this? And let's see what is the impact after the adoption of the of the Finance Act, right? So prior to the adoption of, or the introduction of the Finance Act effective, which was first of all effective in 2020, by that I mean the Finance Act of 2019, some multinationals domiciled in Nigeria or having a fixed base in Nigeria have been using interest payments to related parties outside Nigeria in order to what? In order the registration with the sole aim of maximizing their overall profit. I believe that has been explained before. This was done easily since all interest costs between foreign related parties was to be treated as an allowable expense. So what I meant by that is that consciously in our tax law, you will agree with me that there was no specific section of the tax law before the recent amendment made in 2019 through the Finance Act. There was no portion of any of our tax law that actually addressed instances whereby there is a foreign loan among related parties, right? So what our tax law only speaks to is where you have taken loan from banks within the country of your, or where to whom you have a tax obligation to, or where you have taken a loan from a foreign country, not necessarily stressing whether the local entity is actually in any way related to the foreign entity. So that was a position of our law before. And we try as much as possible to see where and which among all the sections of our tax law actually relates to interest expense. But let me start with this first. Can anybody bring us to speed on when we talk about the taxability of a company, incorporated entity this time, what tax law will be relevant? If you want to look at how a company, not necessarily speaking to any specific industry, any company in Nigeria, what is the main or the primary tax law that you think we should consider? Yeah, okay, thank you very much. That is the Company Income Tax Act. It's only when you are now speaking to specific industry, like the petroleum, that's where you'll be talking about the PIA or PPTA as the case may be. So we are looking at companies that are obligated or that has obligation under CETA. What are the sections of CETA that actually speaks to interest expense? The number one of them that we will refer to is what we call the Section 24 of the Company Income Tax Act. That Section 24 actually speaks to expenses that could have been incurred that will then be treated as an allowable expense. If you go through Section 24, please, I encourage you that after this discourse, you try to create time to review some of these submissions. Section 24 actually speaks to what are those expenses that are allowable for tax purposes, right? The very first among the listed expenses there is interest expense, right? So, and if you look at that section, it did not in any way narrow it down to whether that interest or the principal portion of that interest were actually locally obtained or obtained from any entity that is related, right? It was just a broad way of saying, should you have taken any interest that is entirely or rarely used for business purpose, then such cost of that, should you have taken any loan on which you are expected to pay any interest, that particular interest due, provided you have used that loan for solely for business purpose, then that interest payable on that loan will be regarded as an allowable expense. So that was the provision as far as Section 24 is concerned. So if you're looking at among the various sections that speaks to how interest should be treated, first of all, cite holistically Section 24. Then second one is Section 11 of that same Act. So Section 11 of the Company Income Tax Act, as amended, speaks to instances where there is a charge of prior to tax interest relating to foreign and agricultural loan and certain reliefs. So this speaks to instances where you have obtained loan, whether from a foreign source or otherwise, but these loans are actually used for agricultural purpose or given to those operating in the cottage industry or the manufacturing ones. As far as this particular Section 2 is concerned, it did not emphasize whether there is any relationship between the local entity utilizing the loan and the foreign party giving the loan. As far as this particular section is concerned, it speaks to it that provided this particular loan is used by this entity, then it should be treated as an allowable expense. Then Section 22, though somehow intended to actually address artificial transactions, right? Artificial transactions are said to be transactions, whether loan related or relating to any form of related party transactions that are not done at arm's length, right? As far as this section is concerned, it is expecting that every transaction done by related parties should have been at arm's length, but there were no conscious provisions within the tax law that when such exception, the provision of this section is now violated, what should be done? The only thing that was stressed in Section 22 is that adjustment will be made. How will this adjustment should be made? It was not very thoroughly emphasized. So then the last one that also relates to interest expense technically is the third schedule. The third schedule of the Company Income Tax Act also emphasizes putting the caption or being expressed as tax exemption on certain interests, also speaking to where a local entity has obtained a foreign loan, but it did not still emphasize whether this local entity and the foreign entity offering the loan are in any way related. So there are options open to those parties transacting on the loan arrangement to, in a way, override the interest rates. And when you agree with me that when the interest rate is overhiked, it's just a way of actually taking out so much profit that could have been made or subjectable to tax in Nigeria, being carted to another country. Look at this next section. It speaks to the provision, the further provisions within within the third schedule. So very many people could relate with this, that where you have this caption that loans are obtained from foreign entities, interest on that loan, provided the period of repayment of that loan or the moratorium period is actually above 7 years, right? The the total portion of the interest is expected to have been what? Granted. So, but please, for us to actually put perspective to it, the loan repayment period is not same with what we call the moratorium period. Another expression for moratorium period is the grace period. So where a loan of 7 years or above has been given, provided that there is a period that is not less than 2 years, within which whoever that have taken the loan is not expected to pay not only the interest, but also the principal, then any interest over the years of that loan will be granted 100% exemption for tax purposes. That means any cost that has been incurred will be regarded as a deductible expense. But the first pitfall in this section is that it did not say where that loan has been, where that interest has been unnecessarily overhiked, right? The second instance here speaks to where the loan repayment period is between 5 but less than 7 years, provided the moratorium period or the grace period, the period which no interest nor capital is expected to be repaid, only 70% of the interest is expected to be granted as a relief. Then where the loan is within 2 to 4 years, that is above 2 years, but less than 4 years, with a moratorium period of 12 months, it is only 40% of the interest that will be recognized as a tax deductible. But any loan given for a period of less than 2 years and with no grace period at all, then it means that interest incurred will not be applicable. So let's put this into perspective. This third schedule is only applicable where a company has obtained a foreign loan. If you did not obtain a foreign loan, third schedule is not applicable. So when you're doing your tax computations, you don't just treat as tax deductible the would have been reported interest expense without trying to dig further. Where was this loan obtained from? From whom was it obtained? To what extent is this particular loan actually used for the business? And should there be instances where part of the loan is used for the business, another part is not used solely for the business? It's only the extent to which the loan relates to the business that will be granted as a relief. But further extension, where the loan is not obtained from Nigeria, it's foreign, then this third schedule then needs to appeal to your mind. So let's play with some numbers. Let's assume company A actually obtained a loan from company A in Nigeria, actually obtained a loan from XYZ, which is based in Ghana, and the loan is just for a period of 18 months. If the interest on that loan of say 100 million is 10%, right? What portion of that loan will be granted? What portion of that interest will be granted as deductible expenses? Anyone? Anybody? For the benefit of everyone, so for you to get it very clear, we have ABC in Nigeria and we have XYZ in Ghana. ABC has obtained a loan of 100 million from Ghana for a period of 18 months. And the interest rate on that loan is 10%. What portion of the interest or all of the interest will be will be treated as a deductible expense? How much? Gafar, why do you say it is nil? Why is it nil? Utibe, why is it 7 million? If you are not in a noisy place, you can actually enable your mic and speak to this. But if you're in a noisy place, just communicate via the chat box. Okay, so Itibe is changing his position. Yeah, the repayment period is less than 2 years. Exactly, exactly. Now look at this. Assuming the XYZ Limited is actually located in Nigeria, given that every other information is the same, will your position be different? Will your position be different? I needed to understand which one you are speaking to, Mrs. Otobo. Is it the first scenario or the second scenario? Okay, so please get it clear. The first scenario, we're saying the interest that will be, no interest will be tax exempt. Reason is that that loan is already below 2 years, right? And according to the third schedule, any foreign loan obtained for business purpose, even though it is solely used for the business purpose, but because the repayment period is less than 2 years, none of the interest will be regarded as tax exempt, right? But if the loan is between 2 to 4 years, provided that the moratorium period is 12 months, only 40% of these will be recognized as tax deductible. Then provided it is between 5 to 7 years, that is a low repayment period, but on a condition that the moratorium period, the period during which no interest is expected to be paid and no portion of the capital is expected to be repaid, then only 70% of the interest will be regarded as tax exempt. But any other one above 7 years, provided there will be a minimum of 2 years when neither capital nor interest will be paid, then in that instance, the whole of the interest on the lifetime of the loan will then be regarded as tax deductible, right? Please, I'm taking my time so that you can see, you can actually understand where we were as a nation on the taxability of this tax base and where we are at present due to one or two amendments that have been made in our tax law, right? So for the benefit of those who just joined, what we have spoken to thus far is that we look at instances where a company has just been established or they've been in operation. We are concentrating on how is the asset financed, right? We consider instances where the organization provided for all of its resources, no instrument in the form of debt, whether for short-term purpose or long-term purpose. In that instance, we say, is it tax, will this give any tax benefit? And the submission we reach that is that even though the company may be doing well, it has no obligations and the likes, it may have some other advantages because there is no exposure to take over. But as far as tax is concerned, we say it is not a wise tax decision, right? We also look at instances where some of the finances were provided through debt instruments and we're able to work out that this will give, this could give some tax advantage, right? I won't stress that we also considered the meaning of the term thin capitalization. And we concluded that thin capitalization is just trying to assess the proportion of debt instruments of a company with which it finances operations vis-a-vis its equity instruments. And when the debt is in larger proportion, let's say ratio 2:1, more than the equity, then we say that company is likely to have been thinly capitalized, meaning that it could be exposed to takeover by its debt provider, right? So to what extent should be the standard ratio? Prior to this very moment, no standard ratio was provided. The only thing that was said to it was that if your debt is more than your equity, you are overexposed. If your equity is more than your debt, then it is fair because you will have some portion or measure of tax advantage. But if you don't have any debt at all, of course, it's also fair, but you are also not maximizing the tax benefit that could have been had. Then we're able to speak to what is the expected returns that these finance providers are expecting. The equity providers are expecting dividend. The debt provider are expecting one form of interest or the other. Then we now address this in that respect, that what happens if the providers of this debt are somehow related to the company? It means the interest rate they will have fixed on the debt may not be at arm's length. It could have been at a rate that is higher that could have been obtained from the bank or any finance institutions, right? If these arrangements are being done and these companies are in Nigeria, both the loan provider and the loan beneficiary are in Nigeria, there is no loss per se because the profit is just being shifted from one company to the other, provided that those two entities are also subject to tax. No one is having a tax advantage. There might be no tax loss to the government. But what is of more concern is instances where one company is in Nigeria and the other is in diaspora, right? And they have carried out their transaction in such a way that will give them one form of advantage over the other, particularly where the interest is being moved from the profits outside the country. Then we could say that there could have been one form of benefit or the other. We also emphasize that prior to 2019, the Nigerian government has done nothing deliberately to addressing this concern. But after 2019, there were some deliberate actions that have been introduced, right? We also take into consideration looking at entities in the tax laws we have in Nigeria. What are the sections of the law that speaks to interest expense in particular? We're able to identify section 11 that only speaks to charge of to tax on interest related to foreign loan and agricultural loan and certain reliefs, right? This category actually speaks to loan obtained from a foreign source that is used for purpose, particularly those in the cottage industry or manufacturing, as the case may be. We also make reference to section 22. Section 22 is not specifically addressed to interest, but speak holistically to transactions that could have been done by related parties that were not done at arm's length. By so reference, loan could have been one of those transactions that could have been done as such. But the only proviso that the tax law then provides under this section is that where any of such is identified not to have been carried out at arm's length, it is just said that adjustment will be made and the tax authority may then make the additional assessment where there is such exposure. Then section 24, A, or the paragraph 1 of it, actually speaks to where you have actually incurred as a business expense, interest expense on a loan obtained for business purpose. It says that this loan should then be granted as a deductible expenses. Then third schedule speaks to instances where you have obtained a foreign loan, but with different moratorium period and different repayment period. How is this to be addressed? We've looked at instances where the loan is above 7 years, the loan is between 7 years to 5 years to 7 years, the loan is between 2 to 4 years, and the loan is below 2 years. So let's move to the next one. What then, we are gradually, this section will not take so long a time. We're gradually going into the main area of concern. What has changed effective 2019? However, the Finance Act of 2019 repealed the provision of Section 24. Don't forget, we had identified that there were 4 main sections that speaks to interest deductible as a business expense. So the Finance Act seek to amend Section 24 of CETA, introducing an additional schedule called the 7th schedule. So if you check the two, the law, before the amendment of the Finance Act and after the amendment of the Finance Act, on this subject matter, 2 things change. One is that Section 24, paragraph A was actually amended, and additional schedules, 7th schedule, were actually introduced. So what were the things that changed in particularly leveraging on these introduced sections? So introduced the 7th schedule to restrict deductibility of interest expenses for a Nigerian company or a non-Nigerian company who has a fixed base or significant economic presence in the country on foreign loan-related parties to not exceeding 30% of the EBITDA. You know, I made mention of what we mean by EBITDA earlier on, earnings before interest, tax, depreciation, and amortization, right? So this was a benchmark that was used or proposed to be used in amending where you have obtained a foreign loan from a related party. If the loan is not obtained from related party, the 3rd schedule will still be very effective and applicable. But if the loan is obtained from a foreign source, but at the same time, that foreign source is actually related to the Nigerian entity, then Schedule 7 will be applied. So this is a move. This move was to maximize or minimize the aggressive tax planning used by multinationals, which they have been using to shift profit that could have been taxable from one region to another region where they could have had the tax advantage. The restrictions of Section 24 and the 7th schedule does not apply to Nigerian subsidiaries of a foreign company, right, who is into banking and insurance business. So the only exemption here is that even where you have a company in Nigeria, which is a subsidiary to any foreign entity, and this party obtain loan from the foreign entity, provided the Nigerian entity or the Nigeria branch or subsidiary is into a banking business or an insurance business, this amendment does not apply to them. But where they are operating in any other industry other than these 2 identified ones, then this position is applicable. So it is pertinent to note that the provisions of the Finance Act of 2019 and the 7th schedule of the Company Income Tax Act do not apply to loan between foreign related parties that were also done at arm's length. That is the second caveat. So first caveat is if the related party is into the business of a banking or insurance, it is not applicable. Second scenario is where the related parties loan transaction were done at arm's length, then this caveat is also not applicable. How will you measure whether this loan transaction between the related party are done at arm's length. You look at the interest rates that must have been agreed as a compensation for the provisions of that debt instrument. Benchmark it with what will have been paid or incurred if those loans were obtained locally. If it is the same or not materially different, then we can say this 7th schedule and the amended section 24 paragraph A will not be applicable. The FRS stipulates a penalty of 10% on the excess interest claim by the company who failed to restrict interest on loan from foreign related entities to 30% of the earning before interest tax, depreciation and amortization, and the interest at the prevailing market rate. So this penalty was actually as proposed in the 7th schedule. Please take note of that. Then the position of the amendment to the law is not also saying that the whole of the interest will not be granted. It will be granted, but it will not be granted at once. It will be granted in piecemeal. You will see that as we will illustrate with the example. Any unrelieved interest will then be carried forward to a maximum period of 5 years. If after the 5th year, you have not been able to recoup this interest, then whatsoever that remains unrecouped becomes lost forever. So companies should plan their interest deduction by using first in, first out. What do we mean? You could have taken this loan over certain years. So if the interest expense suffered in the 1st year is already above 30% of EBITDA, in the 2nd year is already above the 30% of EBITDA, then the relief will have to be in terms of what is the first one you have incurred, right? Ensure that that is absolutely or completely claimed as relieved before you go to the next one and in that manner. So you cannot take it using last in, first out, but rather it is the first that you have incurred that must be first of all completely utilized or relieved before you go to the next one. So you take note of that. Then let's look at this illustration. I think it will actually concretize what we are talking about today. So we have a company, I believe everybody is paying attention. ABC Nigeria Limited obtained a loan from its parent company, ABC, in the UK on the 1st of January 2021. The loan is not made at arm's length. Remember the first caveat in that remember the first caveat in the 7th schedule that speaks to the fact that that loan must be at arm's length. If it is at arm's length, you may not apply section 20, schedule 7 and the amended section 24A. But if it is not at arm's length, then it has to be applied. So this loan is not made at arm's length and is not consistent with the transfer pricing regulation 2018 as amended, right? Other terms of the loan are as follows. You have the nominal value of the loan to be 50 million. The coupon rate is 10%. The terms to maturity is 3 years. That is a period during which this loan is expected to be repaid. Then the purchase price is actually 48 million, meaning this loan was actually taken or acquired at a discount. The effective rate of interest is 11.67. Assume the below extracts from the company's financial statements. So given all of this information, I want to reemphasize this again. There is a loan obtained by a Nigerian entity from a foreign entity. The loan was actually taken on the 1st of January 2021, meaning the Finance Act has already taken position. If this scenario were to have taken place before 2019, then all of these conditions that we want to apply would not have been applicable, right? We are applying those two major reference, section 24A as amended and Schedule 7 because it is after the operational date of that amendment. So the nominal value is 50 million, the coupon rate is 10%, the term to maturity is 3 years, the purchase price is 48 million, then effective rate of interest 11.7. All right. So we try to simulate what could have happened across the years because we cannot come out with any proposition if we could not ascertain the EBITDA of the company, right? So that is the relevance of the next scenario. We want to ascertain what is their earning before interest and tax, because that will be a benchmark for which we can then know what proportion of the actual loan interest suffered in each period that will be relieved. If the loan interest suffered in each period is below 30% of EBITDA, then the whole of the interest will be treated as a deductible expense. But if it is above 30% of EBITDA, it will only be the maximum that will be recognized as tax deductible will be the 30%, while the excess will be carried forward. So for this company, we are looking at the operation in Nigeria in 2020, in 2021, and in 2022. We have a revenue of 32.5 in the first year, 38.5 in the second year, and 35 million in the third year. The cost of sales, we have 18 million in the first year, 20 million in the second year, and 19 million in the third year. The gross profit, you have 14.5 in the first year, 18.5 in the second year, and 16 in the third year. Operating costs, including depreciation and amortization, are 5.5 in the first year, 6.5 in the second year, and 6 million in the third year. EBITDA is a workback of that. In the first year is, if you are working this from your financials and you want to ascertain EBITDA, when you ascertain your operating profit, just make sure that interest that must have been deducted before is added back to your profit. Tax that must have been deducted, if at all there is any, is added back to your profit. Depreciation that must have been deducted in the question is added back to your profit. And amortization that must have been deducted before is added back to your profit. That will give you what we mean by EBITDA. So in this instance, the EBITDA in the first year is 9 million. In the second year is 12 million. In the third year is 10 million. Can somebody first of all give us the benchmark? 30% of each of these amount of EBITDA will be what? First year will be what amount? Second year will be what? And third year will be what? I'm sure you are with me. So give us the benchmark for us to ascertain what extent of the loan will be available as deduction. Hello, are you there? 2.7 is for which year? $2.7 is for which year? Okay, first year, thank you. So we have 2.7. What about second year? What about second year? Second year, 3.6, thank you very much. And the third year is 3 million. Thank you so much, Itube. Don't forget what we are using each of these for. It is the benchmark with which, thank you, Tenny. It is the benchmark with which you will know whether the actual interest costs will be relievable or deductible or not. This does not mean that we are deducting 2.7, 3.6, or 3 million. If the interest that is actually suffered in year one is less than 2.7, we will deduct or grant as relief that amount, not 2.7. If it is above 2.7, then we will limit it to 2.7, right? That is the same thing we will do for each of the years, while the excess will then be carried forward. So the amount, let's assume now, we are yet to get to the solution of the question. Let's assume now that the amount of interest in year 1 is actually 10 million. How much will be relieved? Assuming the amount in year 1 is 10 million, how much will be relieved? Assuming the amount is 10 million, okay, UTB confirmed 2.7. How much will be carried forward? How much will be carried forward? $7.3. Tenny, that figure didn't add up to what we have here. Okay, Ichibe, thank you very much, 7.3. How long can we carry forward the 7.3? Azuka, thank you. How long can we carry? 5 years, very well. So I just want to be double sure that we are on the same page. So let's now see contextually what happens in this question. So our requirement is that we are required to determine the interest cost allowable and the amount to be carried forward, if any. So the very first thing is, let's determine the interest cost, first of all. If you go back to the question, you remember that the nominal value is 50 million. The coupon rate is 10%. The terms to maturity is 3 years. The purchase price is 48, and the effective interest rate is 48. So coming in here, we have to put up what we call an amortization table or schedule. Make the 3 years, which is the period, the maturity period for the loan, which is 2020, 2021, and 2022. Starting with the first year, the amortized amount of the loan, the actual amount you actually acquire the loan, even though it was a loan of 50 million, but it was 48 that was paid. So we come up with the 48 first, apply the interest rate on it. The effective interest rate is 11.67. Please, let's press our calculators. 11.67 of 48, will that give us 5.6? Please confirm. Please confirm. What is 11.67% of 48 million? Will that give us 5.6? Please confirm. All right. I will urge every other person to also contribute. But Ichibe, thank you very much for your contribution. So 5.6, how do we get the 5.6? It is 11.67% of 48 million, which is the amortized sum. Then actual repayments each year is 5 million. Who can tell us how we come about that? Actual repayment is 5 million. How do we come about that? Don't forget, the coupon rate is what? 10%. If you apply 10% of that, is 5 million. So that's how we come about that. 10% of 50 million will give you 5 million. So 5 million is the cash payment for each period, right? What we are saying, what we meant by the coupon rate is the actual interest that could have been accruable in cash given to whoever that have taken up this facility, right? While the effective rate of interest is the market rate. So take note of the difference between the two. Cash payment is 5 million. So if you have 48 million plus 5.6, which is the interest that applying the market rate that particular instrument will have attracted to date, less 5 million from it, you have the amortized sum of 48.6. This 48.6 will then be the amount that will be carried forward to the next period. Apply the interest rate of 11.67 on that again. Apply the 11.6%, 11.67% on the amortized cost again. It will give you 5.67, right? Please, can you confirm if that is correct? Confirm if that is correct. Are you all there? Please confirm if that is correct. 11.67 on 48.6. Is that correct? Hello, are you all there? Hello, if you can hear me, please indicate hi. I want to be sure that we are on the same page. Okay, so confirm if 11.67 times 48.6 will give us 5.67. Okay, thank you. So I want to be double sure that everybody is following. Then we deduct the cash payment at that year end of 5 million too from that. So the net of 48.6 and 5.67 less 5.5 million will give you 49.27, right? 49.27 will then be the carry forward sum in 2022. Applying 11.67% on 49.27, will that give us 5.75? Will that give us 5.75? All right. So you know that the instrument initially was a 3-year repayment period or maturity period. So the addition of what you have here, 49.27 and 5.5 will then be repaid in that year. So that total 55 million. So the amortized cost at the end of the 3rd year will then be nil. Having said all of this, what is now of interest to us is the interest that we have calculated at 11.67 in year 1, in year 2, and in year 3. In year 1, it was 5.67. In year 2, it was in year 1, it was 5.60. In year 2, it was 5.67. And in year 3, it was 5.75. So this is now what we want to benchmark against our earlier benchmarking base of EBITDA, 30% of EBITDA. Don't forget, 30% of EBITDA in the first year, we had ascertained that to be 2.7. So given a base of 2.7 and you have your actual interest costs in that first year of 5.3, how much will be carried forward and how much will be relieved? How much will be carried forward and how much will be relieved? How much will be carried forward and how much will be relieved? In the first year, any contribution? To be sure you understand what is being said, we have an actual interest cost of 5.67 and Schedule 7 of CETA as amended provided that because this loan was actually from a related party and the interest rate was not at arm's length, then we have to proportionately reduce it to the benchmark. The benchmark is then that you must not claim above above 30% of the EBITDA. In this question, EBITDA is 9 million in the first year. 30% of that will give us 2.7. So if we have actually incurred an interest of about 5.6 million in the first year, Being that that actual interest cost is above the benchmark, we can only claim as interest 2.7. So our point in essence is this: assuming this has been simulated in a financials and you are doing your tax computation, ordinarily, many people will have seen the 5.67 being reported as the interest expense, and you will just have deducted this as if it is an allowable expense. So our point is this, that if you're making your computations, you cannot claim, the only maximum you can claim in that year is 2.7. So your add back in that year will be 2.9, right? While you owe to claiming the other relief in the subsequent year, right? So what will be our total claim in year 2? What will be our total claim in year 2? Year 2021. What will be our total claim in year 2? I'm listening. What will be our claim in year 2? Who can give us an heads up? Remember, our benchmark in year 2 is 3.6, but the actual interest in year 2 is 5.67. What is the total amount that we can claim in year 2? The total amount we can claim in year 2 is what? Yeah, 3.6. But how do we get this 3.6? You know, we earlier had 2.9 in the first year carry forward, right? So we are recouping the whole of the 2.9. And from this current profits, from this current interest of 5.6, we only take the difference between 3.6 and 2.9, right, as the total claim. So we then carry forward how much? What we will carry forward will then be 5.67 plus 2.9 minus 3.6, which I believe should give us 4.97. Right? If you understand that, please give us what to claim in year 3. How much can we claim in year 3? How much will be claimed in year 3? Don't forget, in year 3, your benchmark is 3 million. So technically, you have a carry forward from the prior year of 4.97. So you can only claim your 3 million out of that sum, while 1.97 will be carried forward. Meanwhile, the whole of 5.75 for that current third year will also be carried forward alongside. So this is the important area we want to expose, draw your attention to. So in summary, in year 1, in line with the provisions of section 24 of CETA, schedule 2, 7 schedule of CETA and the Finance Act, the interest allowable for deduction in first year is 2.7, while the excess of 2.9 will be carried forward. But carrying forward meaning that in that year we will add it back and tax will be paid. But meanwhile, in the subsequent period, we can then claim the relief. The excess interest of 2.9 will be brought forward in the subsequent period. And we make a total adjustment of, from the current profit, 0.7 in addition to the 2.9 to make the total of the 3.6 benchmark in the second year, while 4.97 will be carried forward. But in third year, you have a total of 3 million as the benchmark, but 4.97 is already a carry forward. So you recoup the 3 million from the 4.97, carry 1.97 from the prior period, in addition to the 5 million plus that you have in the current period, giving you a total of 7.7 0.72. So that is what the outlook looks like in the first scenario. Any question before we quickly look at the second scenario and we wrap it up? Any question on that before we look at the second scenario and we wrap it up? Any question? Please, if there is no question, just indicate hi on the chat box so that I can continue. If you understood what I've been said thus far, just indicate I on the chat box so that we can go on. Anyone? Okay, we're good. That being said, another possible scenario is when a company has a loss before interest, tax, depreciation, and amortization. You know, earlier on we said we have to calculate your EBITDA, and you cannot calculate your EBITDA if the value is not a positive. But what happens in reality, because we also know that there are instances where your earnings or your earnings in that very period could be negative, meaning you have operating loss, as the case may be. If after you have adjusted interest expense, tax, depreciation, and amortization on your earnings, and it is still a negative figure, what then would happen? The implication of that is that the benchmark for your estimate will be 0. So technically, if you have no operating profit in any year, and your EBITDA in that particular year that you have incurred a foreign interest expense from a related party loan, you cannot claim anything as relief. The whole of that will be added back, while you can then continue to carry forward the unrecouped interest expense to a later period when there will then be sufficient earnings against which to claim it. So this second scenario speaks to that. Speechy Nigeria Limited has been in business for long. It obtained a loan from its parent company, Specialita USA Limited, in the year of 1st of January 2021, with a time frame of 4 years, that is repayment period. The term of the loan were not made at arm's length and not consistent with Nigerian income tax pricing, transfer pricing regulation 2018 as amended. Extracts from the financial statements of the year ended at 31st of December 2021 is as follows. So let's see. So for this very company, we only have revenue 27 million, cost of sales 22 million, gross profit is 5 billion, depreciation is 2.5, other operating cost is 9.5. The operating loss we have in that year is 7 million. If you net the 9.5, 2.5 from the 5 million, you have 7 million. However, they have an interest cost of 4 million. If you adjust this back, adding interest cost to the operating loss and adding depreciation of about 2.5 to it, you have your loss before tax to be 11 million. That being said, I haven't adjusted that. That being said, determine the interest costs to be allowable for the period. So you have your loss for the period to be 11 million. If I had my interest cost to it and I had my depreciation to that, what would be my EBITDA? So this is what we did. We had the interest cost to the depreciation alongside the negative loss we already had. We have an EBITDA of 4.5. 30% of that 4.5 is already a negative of 1.350. So that technically means that our benchmark against which to claim that interest is already 0, because there cannot be a negative EBITDA. In that wise, every actual interest suffered in each of the years, there will not be any claim in that first year until any other period to which you then have a positive EBITDA. That is our position on this. So in conclusion, companies are advised to use first in, first out method, as we have earlier said. So what we then mean is that imagine in the 2022 year of assessment, when that our last scenario will be subject to tax, that company should not be saying, oh, year 2022 account, we are having a positive EBITDA, right? It is wrong. You have to use the first in, first out as your claim. This article does not apply to interest on foreign loan between non-related parties. So if if between the contracting parties, there is no form of control there or related party relationship there, then we will not apply section 20, schedule 7, right? The only thing that will then be applicable is the amended third schedule that has been provided consequent to the amendments in Finance Act of 2019. Any question? That is a brief we wish to give to you today. I believe we've been able to make, draw your attention to certain areas that is very crucial to your work. Any question before we wrap it up? Any question? Is there any question? Is there any area you want us to further clarify? Or in the course of our presentation, you have anything you want us to speak to? Any question? All right, so in the absence of any question, I believe this is an eye opener. For more clarity and application of this, please, we will urge you to look at the relevant provisions in the tax law, and the ones that speaks to this particular position that we put forward is section 11, and we also have section 24 that we also reference in the course of our presentation. We have section 22 that is also very key. We have schedule 3 that speaks to instances whereby you have obtained a foreign loan, but not from a related party. Then the new one is the schedule 7 that is just newly added, that speaks to loan obtained from related party. Gafar, you have the floor. You have the floor. You can unmute yourself, but ensure that there is no noise from your background. Gafar, I have your hands up. You have the floor. Okay, you can use the chat box if you don't want to speak. All right, so while we are expecting the question from Gafar, is there any clarity or contribution anybody want to make? Oh, you're unable to unmute. That's strange.
Yeah, good evening.
Yeah, good evening.
Yeah, can you hear me clearly? Can you confirm
very
if you
well.
can hear me clearly? Okay, yeah. I first and foremost, I would like to appreciate you for giving us, for organizing this training session so that so that others can actually benefit. So my question is that I actually want to ask, okay, when you talked about the foreign loans, so that is, I think it is the foreign loans where we are having some, where we are having some conditions before we can be allowed to deduct some interest
Gafar, we are breaking.
or not. So, but now my question now is this:
Gafar, we are breaking. I can barely hear you.
Hello, can you hear me?
It's better now. Gafar, go ahead. It's better now.
Okay. Yes, thank you. So I've been able to unmute myself. So I said that when you are, I actually have some clarity in terms of the foreign loan because I knew that it was when we are talking about the foreign loan that we have some certain conditions whereby you may be allowed to have a tax deduct. Where you may be allowed to deduct it or not. So now I just want to speak to this area whereby we have a new arrangement of finance. For instance, maybe I want to buy an asset from abroad, and in the agreements, the cost of the assets is, let's say, is maybe like $2 million, but it's now been stated in the agreement that because I do not have my own money to buy it, maybe a company may want to buy it for me, and then they may now charge an interest on it just because they are using their own money to buy. So in that situation, by the time I will be recording such in my own books, the extra amount that I'm paying on that transaction will actually be regarded as an interest. So do we still, as in, does the tax will still allow me not to deduct such interest from my income as a deductible expense?
I think that is a very good question. But for financial reporting purpose, you know that because you are acquiring an asset, and I think depending on what form of assets that you are acquiring, if it qualifies as PPE within the relevant provisions of IAS 16, that asset will have been capitalized. So my point is interest cost or any other incidental cost of that nature for asset acquisition will have been capitalized. So it will not be treated in this same way, right? We are looking at, for the relevant provisions of these sections, we're actually looking at instances where the loan you have obtained is actually for OPEX purpose and other operating costs by so which you will have had a need to report that expense as a line item on the component of your financials. So these caveats may not entirely work in this scenario because you will have reported that interest cost as part of the cost of your asset. Does that speak to what you want, or you still have need for any clarity? Gafar, are you there?
Hello? Yes, it's
Yeah.
clear now. It's clear. It's clear now.
Okay.
Yeah, thank you.
So just look at where is the reporting line? What is the underlying transaction for which that loan was used for? If it's for acquisition of assets, note in line with IAS 16, that cost will have been capitalized. And it may not even be visible to the tax authority because your relevant document will just even show the total costs, right?
Okay, sorry, Mr. Cole, but my question is, what if that same asset we are talking about is actually an inventory? So, as in, what will now be, will the scenario now change?
Yeah, the scenario will change because when you acquire, if what you have acquired is an inventory,
Yes.
The provision is very clear that the actual cost of that inventory may then be separate from the incidental interests. Do you understand? Because in this instance, you are looking at the interest expense as the cost of finance, not the actual cost of the inventory you have acquired.
Yes.
Right? So in this instance, you will then need to ask further, do we obtain this loan from a related party? If it is not obtained from a related party, Schedule 7 will not still be applicable. It is only Schedule 3.
Okay.
So, but if it is from a related party, meaning that the transaction may not have been at arm's length, right? You would then have to apply Schedule 7.
Okay.
Is that clear?
Yes, it is. Yes, it is. Thank you so much.
All right. Any other question from anyone? Utibe, any contribution or question? Lizzie, Sheung, any contributions or questions? All right, so if there is no question, this is where we will then wrap it up today. For familiarization, I think it is fair if for those who are disposed to doing so, you might enable your video. I think this is also a good platform for us to get to know each other. Not many people that are here, if I see them on the road, I probably may not be able to identify them. So enable your video so that we can see each other. If possible, you can even exchange contacts, right? I think it's a good way to network. So for others, please do. I'm trying to enable mine too. Wow. Can you guys see me? Oh, Ezekiel, oh, you are there. Welcome. Ezekiel Clements. Okay, yeah. So I'm sure for many people that even that we cross our paths in maybe in tax offices and the likes, if you've not been able to put a face to my name, you probably might not know that I'm the one. So here is the code I've always been speaking to you. Utibe, we can't see you. Who is TA? Who is TA by name? What is the full name, sir? I just saw TA. What is your full name, sir? Oh, Toby. Good, 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 good. Mr. Itube, good to see your face again.
Hi, Ikole.
Yeah.
Yeah, sorry, I was on another call, so I've been out for some minutes actually.
Yeah, it's fine. It's fine. It's fine. And Clement, I say hi to. Thank you for joining. Ezekiel, good to have you. Cousin is also there. You are welcome. Technocanon, come on. Who is Technocanon? What is the name? Sean, thank you for appreciating us. Thank you so much. Lizzie, you're welcome. Toluwanimi is there, Theni is there. All right, so thank you very much. This is where we're going to draw the curtain tonight. We'll keep you updated on other episodes that we will be sharing. I wish you all the best and do have a very splendid weekend. Thank you.